Would you be better off putting your retirement account on autopilot? I'm Jack Otter, editor of BARRON'S.com. I'm with Andrew Bary, an associate editor at the magazine. Andrew, you wrote a cover story for BARRON'S on these things called target date funds, which are taking over the 401k market. First of all, can you just explain what they are?
Well, they're basically supposed to be one-stop shopping for participants in 401k and other retirement plans. They're essentially a diversified mix of stocks and bonds in a single mutual fund, and the asset allocation of those funds shifts over time to become more conservative as you approach retirement.
So do you think this is a good idea? Should people do it?
Yeah, I think it's a pretty good idea for people. I think many people try to do it yourself and do their own investing and manage their own 401k plans or IRAs. This basically is a pretty simple way to do it, and many of the funds are pretty good.
Now, obviously one could argue as to what the ideal asset allocation is. People have that battle all the time. One of the things that I like about these funds, though, is they have a behavioral benefit, which is, among other things, rather than you in a market crash having to step up, sell bonds, and buy stocks, they do it for you. So they psychologically, it's a little bit easier just to put all your money in this thing and let somebody else do it.
Well, that's true. I mean, they do reallocate the stock and bonds to maintain a pretty fixed ratio. It should be said that there is a high allocation toward equities for most of the life of these target funds. So if you're in your 30s, 40s, or even into your early 50s, you might have 75, 80, or as much as 90% of the investment in these funds in stocks. So you're taking a good deal of equity risk right now.
Well, that was one criticism even in 08. Some people who were very close to retirement took a pretty big hit. Not as big a hit as they would have had they been, say, all in equities. But on the reverse side, a lot of people were defaulting just into the money market fund. They thought, well, it's safe, I'm not going to lose money, and it's really a guaranteed way not to have enough money in retirement.
Right, especially with inflation right now. If you're in a money market fund or even a stable value fund, you're going to not keep up with inflation or barely keep up with inflation. This offers you a fighting chance to have a reasonable amount of money for retirement.
Now, that said, are there any other downsides of these?
I think the equity allocation is a key thing. I think fees are relatively low, and I think for many people who don't want to be bothered in terms of managing their 401k plans, I mean, these funds essentially manage it for you. So it's a good option that's taking over the 401k market. As much as half of all contributions are now going into these target date funds, and within 5 years, it could be the predominant investment for most people in their 401k plans.
Even if you don't think they're perfect, I would certainly say that there are far worse ways to invest your retirement than these.
That's true.
Thanks very much, Andrew.